Hi, I am Abbas Watoli, Assistant Professor of Commerce, Amal College, Nilambur. Today, I am explaining the newly introduced Goods and Services Tax. GST is India's single biggest tax reform undertaken since independence. By amalgamating a large number of central and state taxes into a single tax, it has simplified indirect taxation, reduced complexities, and removed cascading effect of taxes on goods and services. From the point of view of consumer, the biggest advantage would be in terms of a reduction in the overall tax burden on goods and services. This discussion will help you to understand the basics of GST, important terminologies and concepts, and how this might affect the business and economy in the long run. History of GST India 1999. The concept of GST was first conceived in a meeting with the then Prime Minister and the Economic Advisory Panel. 2000. As a result, Vajpayee set up a committee headed by Azim Das Gupta to design GST. 2006. Then Finance Minister proposed to introduce GST from April 2010 in his budget speech. 2007. Empowered Committee of State Finance Ministers (EC) formed joint working group to finalize GST. 2008. EC finalized the dual GST structure for India. 2016. GST bill passed in both the houses and the president gave his assent to it. 2017. GST Act enacted and implemented from the midnight of 30th June 2017. What is GST? Goods and Services Tax is a comprehensive, multi-stage, destination-based tax that will be levied on every value addition. It is comprehensive because 17 various taxes previously levied by state and center have now been merged in to form GST. So it is comprehensive. It is multi-stage because GST is levied at every stage of supply chain, from purchase of raw material to manufacture to wholesale to retail and to final consumer. It is destination based tax. That means the tax revenue is finally goes to the state where the goods is consumed. So it is a destination based consumption tax. It is levied on every value addition. That means the tax is levied only on value addition. Central taxes merged with the GST. Central excise duty, duties of excise, medicinal and toilet preparations, additional duties of excise, goods of special importance, additional duties of excise, textiles and textile products, additional duties of customs, commonly known as countervailing duty, special additional duty of customs, service tax, cesses and surcharges insofar as they relate to supply of goods or services. State taxes merged with the GST. State VAT, central sales tax, purchase tax, luxury tax, entry tax, entertainment tax, taxes on advertisements, taxes on lotteries, betting and gambling, state cesses and surcharges insofar as they relate to supply of goods and services. This diagram is to explain the supply chain and various taxes at different stages of supply chain. Buying raw material attract input VAT. Manufacturing attract excise duty. Sales to wholesaler attract output VAT. Sales to retailer attract output VAT. And sales to final consumer also attract output VAT. The importance here is input VAT, excise duty and output VAT are separate and cross set-off were not permitted. Pre-GST tax liability. Here is an example. Buys raw material at 100, cost 100, assume 10% tax, total 110. He spent rupees 40 for manufacturing, so cost 150, 10% tax rupees 15, total 165. And he spent rupees 30 for value addition, so cost 195, tax 19.5, total 214.5. As input VAT, excise duty and output VAT are separate and not permitted for cross set-off, here total cost 170, total tax 44.5 and price is 214.5. Post GST tax liability. See the same situation. Raw material purchase at 100, 10% tax rupees 10, tax liability 10, total 110. Spend rupees 40 for manufacturing, cost 140, 10% tax 14. But here set off of input tax is possible. So net tax liability is 4, 154. Again add value for 30 rupees. So cost 170. Total tax at 10% is 17. But he can claim input tax credit for the taxes already paid, rupees 14. So actual liability is 3. So price 187. So here cost 170, actual tax liability 17, so price is 187. So see the difference. Pre-GST at 10% tax rate the price was 214.5, and post GST at 10% tax rate the same item is price is reduced to 187. This price reduction is because of complete elimination of cascading effect of taxes or double taxation of taxes. Benefits of GST helps to create a unified common national market for India, giving a boost to foreign investments and Make in India campaign. Prevent cascading of taxes as input tax credit will go available across goods and services at every stage of supply. Harmonization of laws, procedures and rates of tax across states. More efficient neutralization of taxes, especially for exports, thereby making our products more competitive in the international market and give boost to Indian exports. Uniform SGST and IGST rates will reduce the incentive for evasion by eliminating rate arbitrage between neighboring states and that between intra and interstate states. Reduction in compliance cost. No multiple records keeping for variety of taxes. So lesser investment of resources and manpower in maintaining records. Simplified and automated procedures for various processes such as registration, returns, refunds, and tax payments. Final price of goods is expected to be lower due to seamless flow of input tax credit between the manufacturer, retailer, and service supplier. Relatively large segment of small retailers will be either exempted from tax or will suffer very low tax rates under a compounding scheme. Purchases from such entities will cost less for the consumers. Average tax burden on companies is likely to come down which is expected to reduce prices, and lower prices means more consumption and more production. Now, features of GST, that or various provisions in the GST Act regarding registration, exemption, rate of tax, etc. GST would be applicable on supply of goods or services as against the present concept of tax on the manufacture of goods or on sale of goods or on provision of services. It would be a dual GST with the sender and the state simultaneously levying it on a common base. The GST to be levied by the sender would be called Central GST, CGST, and that to be levied by the states, including union territories with legislature, would be called State GST, SGST. Union territories without legislature would levy Union Territory GST, UTGST. An integrated GST, IGST, would be levied on interstate supply, including stock transfers of goods or services. So, GST on intrastate movement, CGST and SGST will be levied, and on interstate movement, integrated GST or IGST will be levied. Import of goods would be treated as interstate supplies and would be subject to IGST in addition to the applicable customs duties. Import of services would be treated as interstate supplies and would be subject to IGST. Export would be zero rated. GST would apply to all goods and services except alcohol for human consumption. Electricity is also kept outside of GST. GST on 5 specified petroleum products, crude, petrol, diesel, ATF, and natural gas, would be applicable from a date to be recommended by the GSTC. Tobacco and tobacco products would be subject to GST. In addition, the sender would continue to levy central excise duty as cesses. The threshold exemption limit would be Rs 20 lakh. For special category states enumerated in Article 279A of the Constitution, the threshold exemption limit has been fixed at Rs 10 lakh. A compounding option, that is to pay tax at a flat rate without credits, would be available to small taxpayers having an annual turnover of up to Rs 75 lakh. The threshold exemption and compounding scheme would be optional. Existing tax incentive schemes of central or state governments may be continued by respective government by way of reimbursement through budgetary route. Rate of tax under compounding scheme. Manufacturers 1% CGST and 1% SGST, total 2%. Suppliers of food items 2.5% CGST and 2.5% SGST, total 5%. Other supplies 0.5% CGST, 0.5% SGST, total 1%. There would be four tax rates, namely 5%, 12%, 18%, and 28%. Rate for precious metals is an exemption to 4 tax slab rule, and the same has been fixed at 3%. GST rate on rough diamonds 0.25%. A cess over the peak rate of 28% on certain specified luxury and demerit goods like tobacco and tobacco products, pan masala, aerated water, motor vehicles, etc. Cigars attracts an additional cess up to 21% or Rs 4.170 per stick. In order to ensure single interface, all administrative control over 90% of taxpayers having turnover below Rs 1.5 crore would vest with state tax administration and over 10% with the central tax administration. Further, all administrative control over taxpayers having turnover above Rs 1.5 crore shall be divided equally in the ratio of 50% each for the central and state tax administration. Rate of GST: 7% items exempted, 14% items are in the 5% slab, 17% items are in 12% slab, 43% items are in 18% slab, and 19% items are placed in 28% slab. Exempted items include food grains, cereals, milk, jaggery, common salt, etc. 5% slab is applicable on coal, sugar, tea and coffee, drugs, medicine, and edible oil, and so on. 12% slab applicable on fruit juices, vegetable juices, beverages containing milk, jams, etc. 18% for kitchenware, hair oil, soap, toothpaste, glass fiber, and so on. And 28% GST on air conditioners, refrigerators, and other consumer durables. 28% plus cess, small cars 1% or 3% cess, luxury cars 15% cess, etc. Regarding services, exempted items are education, healthcare, residential accommodation, hotel with a tariff below 1000 rupees per night. And in 5% slab, goods transport, rail tickets, economy class air tickets, cab aggregators, selling space for advertisements in print media, 12 to 18% slab work contract, business class air travel, telecom services, financial services, restaurant services, hotel with a tariff between 1000 and 7500. And in 28% slab, cinema tickets, betting, gambling, hotel with a tariff above 7500 per night. Input tax credits ITC to be broad based by making it available in respect of taxes paid on any supply of goods or services, or both used or intended to be used in the course or furtherance of business. Every registered person entitled to take credit of input tax carried forward under any existing law or goods held in stock on the appointed day. Electronic filing of returns by different class of persons and different cut-off dates. Obligation on electronic commerce operators to collect tax at source at such rate not exceeding 2% of net value of taxable supplies out of payments to suppliers supplying goods or services through their portals. System of self-assessment of taxes payable by the registered person. Concept of TDS for government departments. Refund to be granted within 60 days. Regarding GST returns, GSTR1. Details of outward supplies of taxable goods and services effected before 10th of the next month. GSTR2. Details of inward supplies of taxable goods and services effected claiming input tax credit before 15th of the next month. GSTR3. Monthly return on the basis of finalization of details of outward supplies and inward supplies along with payment of amount of tax before 20th of the next month. GSTR4. Quarterly return for compounding taxable person before 18th of the month succeeding quarter. GSTR9. Annual return before 31st December of next financial year. Now some terminologies in the GST Act. GST identity number or unique identity number. UIN is unique identity number granted to specialized agency of UNO or any multilateral financial institutions and organization notified under the United Nations Privileges and Immunities Act 1947, consulate or embassy of foreign countries. GSTIN is a unique registration number granted to person other than POW. Here is a complete breakup of the proposed GST identification number. Each taxpayer will be allotted a state-wise PAN-based 15-digit goods and services taxpayer identification number. The first two letters indicate the state code, followed by 10-digit PAN number. Reverse charge. Reverse charge means the tax liability to pay tax to the government is on the recipient of goods or services or both instead of the supplier. GST registered entities procuring goods or services from unregistered dealers, dealers with turnover less than rupees 20 lakh would need to pay GST on such procurement. If purchases below rupees 5,000 per day, then there is a waiver from paying GST. E-way bill. E-way bill is an electronic way bill for the movement of goods which can be generated on the GSTN portal. A movement of goods of more than rupees 50,000 in value cannot be made by a registered person without an e-way bill. E-way bill also be allowed to be generated or cancelled through SMS. When an e-way bill is generated, a unique e-way bill number is allocated and is available to supplier, recipient and the transporter. Goods and Service Tax Network is a non-profit, non-government organization. It will manage the entire IT system of the GST portal, which is the mother database for everything under GST. Private players own 51% share in the GSTN and the rest is owned by the government. Here is an example how GST works. If a trader in Maharashtra sells goods worth rupees 10,000 to B, another trader in Maharashtra. If GST is at 18%, then 9% goes to the sender and 9% goes to the state as it is an intrastate trade. Again B, trader in Maharashtra sells goods after making a value addition to C, he is in Rajasthan for 17,500. As it is an interstate sale, here IGST will be levied at 18%. So IGST 3,150 go to the sender. Again, this C, trader in Rajasthan, after adding a value to the goods, sells it to D. He is also from Rajasthan for 30,000 rupees. Again, it is an intrastate sale, so SGST at a 9%, 2,700, and CGST 9%, 2,700 will be levied. So now the situation is, in the first step, A sold goods to B 10,000 rupees worth value. So Maharashtra collected 9%, 900 rupees, and central government collected 900 rupees. In the second stage, B sold the goods to C at 17,500. It's an interstate sale, so central government collected 3,150 at 18% IGST. Here, B can claim tax credit for already paid 900 rupees CGST and 900 rupees SGST. So net amount he paid is 1,350. Now C sells this goods to D at 30,000 rupees. So Rajasthan government charge 9%, 2,700, and central government charge 2,700. Out of this 2,700, C can claim input credit, IGST credit 450 and IGST credit 2,700 from the center. So the net amount paid is 2,250 and to the central government 0. So total receipt by Maharashtra government 900, Rajasthan government 2,250 and central government 2,250. So as it is a destination tax, the tax revenue should go to the Rajasthan government. Central government always get a 50%. So the adjustment is the 900 collected by Maharashtra will go to the 450 to the Rajasthan and rupees 450 to the center, and final effect is rupees 2,700 tax will be given to Rajasthan and 2,700 tax will be given to the central government. Here Maharashtra government will get no tax as it is a destination tax. GST Council. A Goods and Service Tax Council shall be constituted comprising the Union Finance Minister and the Minister of State and the State Finance Ministers to recommend on the GST rate, exemption and threshold, taxes to be subsumed and other features. Decision in GSTC would be taken by majority of not less than 3/4 of weighted votes cast. Now, impact of GST. How the newly introduced goods and service tax impact the economy and business in the medium term. Goods and service tax will not have an upward impact on inflation. The GST could help lower the inflation rate by 10 to 50 bps. The medium term addition to GDP growth from this reform will be closer to 40 bps. GST will take a few quarters to settle in, resulting in a slightly stunted growth. Food inflation contributes almost half in the computation of inflation. Agricultural products have been kept out of the ambit of GST, so there is no concern of inflation due to GST. 1 lakh jobs will be created in the next 3 months. Service sector component in CPI is around 20%, whereas they account for almost 50% of the total consumption basket in the economy. So increase in the service tax from 15% to 18% will have neutral impact on inflation. There is a lot of uncertainty over transition from the old indirect tax regime to GST. Manufacturers and producers are keeping their inventory at minimum levels and not rushing to boost production in the near-term quarter. Several developed nations such as Australia, Malaysia, Canada and Singapore have witnessed a fall in their growth numbers immediately after the rollout of GST. Inflation rate in India averaged 7.06% from 2012 until 2017, reaching an all-time high of 12.17% in November of 2013 and a record low of 1.54% in June 2017. FMCG will have a positive impact. Pharma will be negatively impacted because increase of tax from 9% to 12%. Consumer durables will have neutral impact. Present tax rate is 27% and GST is 28%. Airline in total will have a negative impact as the rate on business class travel increased from 9% to 12%. Telecom will have negative impact. Service tax increased from 15% to GST 18%. Automobiles will have positive impact. GST rates is almost 4% lesser than the previous rate. Cement also have a neutral impact. Thank you for watching. Email me at abbasvatoli@yahoo.com.